The grocery order that changed everything arrived, like most of them did, through a smartphone. It was 2020. Restaurants were closed. Supermarket lines were long, and the anxiety of being inside them was real. Across the United States, households that had never ordered groceries online were downloading Instacart for the first time, typing in their addresses, selecting their items, and waiting for a stranger to shop on their behalf. The service had existed since 2012, had grown steadily, had raised venture capital in successive rounds, and had spent years convincing consumers and grocery chains that same-day delivery was a viable category. It had not, as of early 2020, achieved the kind of scale that would justify the valuations its investors believed it deserved. The pandemic solved that problem in approximately 6 weeks. By the middle of 2020, Instacart's order volume had increased by a factor that its infrastructure had not been built to absorb. The company hired tens of thousands of additional shoppers. It expanded its retail partnerships. Its app climbed the download charts in categories it had never occupied. The grocery chains that had been cautious about committing to a third-party delivery platform suddenly needed the capability immediately, and Instacart was the company that had built it. In March 2021, the company raised a funding round that valued it at $39 billion. The number was extraordinary. Instacart was a grocery delivery intermediary, a platform that connected consumers with gig workers who shopped at stores the company did not own, using software the company had built to coordinate logistics it did not fully control. Its take rate, the percentage of each transaction it retained, was constrained by the economics of physical grocery and by the competitive dynamics of a market that included Amazon Fresh, Walmart's own delivery infrastructure, and a growing list of regional competitors. The $39 billion valuation required a reading of the future in which pandemic-era grocery delivery adoption would be permanent, in which Instacart's competitive position was defensible, and in which the interest rate environment that made high multiple growth valuations rational would continue indefinitely. Every one of those readings would, within 18 months, require revision. The question of when Instacart would go public had been circulating since at least 2019. The company had engaged advisors. Confidential filings and public market preparations had been discussed internally. The IPO was always approaching and never arriving, a condition familiar to anyone who had followed the company's communications through the years before the pandemic. When the pandemic pushed the valuation to $39 billion, the question became more urgent from outside. Institutional investors who were watching the IPO market run at conditions not seen since the late 1990s were asking when Instacart would move. The company did not move. The internal logic of the delay, as documented in reporting from that period, reflected a belief that the $39 billion valuation was a floor rather than a ceiling. The pandemic had demonstrated the scale of consumer demand for grocery delivery. Instacart had captured a significant share of that demand. The platform's relationship with major grocery chains, Kroger, Costco, Albertsons, Publix, represented a network of partnerships that would take years for any competitor to replicate. The advertising business that had been developing quietly inside the company, a retail media platform that allowed consumer packaged goods brands to pay for placement within the Instacart app, was generating revenue at margins significantly above the delivery business itself. The argument for waiting was that the business was still becoming something, and that going public before it fully became that something would lock in a valuation that the subsequent quarters would exceed. Apoorva Mehta had founded Instacart in 2012, building it from a 2-person experiment in San Francisco into the dominant grocery delivery platform in North America. He had been the company's CEO for its entire history, through the years of slow growth, the venture rounds, the repeated near-death experiences that most startup narratives acquire in retrospect. The pandemic had validated everything he had built. The $39 billion valuation was the market's acknowledgement of that validation. In August 2021, Mehta stepped down as CEO. He retained the title of executive chairman. The new CEO was Fidji Simo, who had spent a decade at Facebook, most recently as the head of its app division, overseeing one of the most complex consumer products in the world. Simo was not a crisis hire. The transition had been planned. Mehta had described his desire to take on a new challenge, and the board had concluded that the company's next phase, the IPO, the public market accountability, the platform expansion, required a different kind of leadership than the founder-CEO model that had brought it to where it was. Simo arrived into a company that was already navigating a shift it had not fully processed. The pandemic-era order volumes that had driven the $39 billion valuation were beginning to normalize. Consumers who had ordered groceries online out of necessity were returning to stores. The cohort of first-time Instacart users acquired during 2020 was retaining at rates below what the valuation had assumed. The delivery economics, the cost of paying gig workers, processing credit card fees, managing customer acquisition, and maintaining the technology infrastructure had not improved enough to convert the revenue growth into the kind of margin profile that would justify the valuation at a public market level. None of this was visible in the $39 billion number. It was priced into the belief that the trajectory would continue, that the consumer behavior change was permanent, and that the advertising business would scale fast enough to transform the company's unit economics before the market asked questions. The market began asking questions in late 2021, when the Federal Reserve signaled in November 2021 that it would begin withdrawing the monetary accommodation that had held interest rates near zero since March 2020. The effect on high multiple growth valuations was not immediate, but it was directional. Companies priced on the assumption that future cash flows deserved minimal discount, because the risk-free rate was essentially zero, faced a reckoning as that rate began to move. For Instacart, which was priced at a revenue multiple that assumed not just continued growth but an acceleration of that growth, the repricing dynamic was acute. By early 2022, the company had begun an internal process of adjusting its own valuation benchmark. The $39 billion figure, which had been the reference point for employee equity grants, investor expectations, and any future IPO pricing discussions, was reduced, first to approximately $24 billion, then to $15 billion, then to $13 billion. Each reduction was documented internally, reported in the financial press, and received by the broader market as evidence of a gap between what the pandemic moment had implied and what the business could actually sustain. The sequence of haircuts was not a surprise to anyone who had followed the public market trajectory of Instacart's nearest comparable, DoorDash, which had gone public in December 2020 at a valuation above $40 billion and had seen its stock fall more than 70% from its peak by mid-2022. DoorDash's public market experience was a preview of what Instacart would have encountered had it moved in 2021. The conditions that produced the DoorDash IPO price, the zero-rate environment, the pandemic delivery premium, the institutional appetite for high-growth consumer platforms, had not survived the first 2 quarters of the Federal Reserve's tightening cycle. An Instacart IPO in late 2021 or early 2022 would have priced into the same dynamics and faced the same correction. Whether it would have priced higher than the eventual September 2023 offering, given the conditions of that earlier moment, is the calculation that the record cannot fully resolve. But the evidence from DoorDash's trajectory suggests that the answer is yes, and by a substantial amount. The IPO window that had been open in 2021 was not fully closed in 2022. It was severely narrowed. The market for large technology listings had contracted sharply. Companies that might have gone public at revenue multiples of 20 or 30 times in 2021 were being told, by their advisors and by the public market comparables, that the multiples available in 2022 were less than half of that. For Instacart, which needed to go public at a valuation that did not embarrass the investors who had committed at $39 billion, the arithmetic of the available multiples made the timing impossible to accept. So the company waited. Again. In July 2022, Fidji Simo was formally appointed chair of the board of directors, with Apoorva Mehta completing his transition off the board, effective when the company eventually went public. The announcement was administrative, but its timing was notable. The company was now fully in its post-founder phase, led by an executive recruited specifically to execute an IPO that had still not been filed, at a valuation that had fallen to roughly a third of its peak, in a market that was asking hard questions about whether grocery delivery, as a standalone business category, was structurally profitable at scale. Simo's response to those questions was the advertising pivot. The Instacart ads platform, which had been developing since 2019, was reframed as the company's primary growth engine and margin driver. The logic was sound. Retail media, the placement of brand advertising within the shopping environment of a platform with known consumer purchase intent, was one of the highest margin businesses in digital advertising. Amazon had demonstrated this at enormous scale. Instacart, with tens of millions of users actively engaged in the act of grocery shopping, had a first-party data asset that consumer packaged goods companies would pay significant premiums to access. The pivot was real, and it worked, in the sense that advertising revenue grew substantially and improved the company's overall margin profile. It also carried a framing risk that the company managed with varying success. Instacart had built its consumer relationship on the premise of being a neutral grocery delivery service. Repositioning as an advertising platform, even while maintaining the delivery service, changed the nature of the company in ways that some long-tenured retail partners and consumers read carefully. By the time Instacart filed its S-1 with the Securities and Exchange Commission on August 25, 2023, the document it submitted showed a company that had reached profitability on an adjusted basis, was growing its advertising business at rates that justified meaningful revenue multiple expansion, and had a retail partner network that remained the largest in North American grocery delivery. It also showed a company pricing its IPO at a valuation of approximately $9.9 billion, roughly 75% below the $39 billion that the March 2021 funding round had established as the benchmark. The IPO priced at $30 per share on September 18, 2023. The following morning, shares of Maplebear Inc., Instacart's legal corporate name, opened on the NASDAQ Global Select Market at $42. The stock closed the first day up approximately 12% from the IPO price. By any conventional measure of IPO performance, the debut was successful. The book had been covered. The stock had popped. The company had raised approximately $660 million. What the first-day performance could not change was the math of the distance. Investors who had committed capital at the $39 billion valuation, and the employees who had received equity grants benchmarked against figures in that range, were looking at a public market that had assigned the company a value less than a quarter of what the pandemic moment had implied. The equity grants that had been issued to employees at strike prices reflecting the $39, $24, or $15 billion valuations were, at a $9.9 billion public price, underwater. The liquidity event that the IPO was supposed to provide, the conversion of paper wealth into real cash, was for a significant portion of Instacart's workforce, a conversion that produced far less than they had been told to expect. This was the decision that cost billions. The sustained delay between March 2021, when the $39 billion valuation was set, and September 2023, when the IPO finally occurred at approximately $9.9 billion, was not a single moment of indecision. It was a sequence of judgments: that the valuation would hold, that the market would recover, that the advertising pivot would produce a re-rating, that the right quarter was always the next one, each of which was internally defensible and cumulatively catastrophic for anyone holding equity at the peak price. The market that Instacart eventually entered in September 2023 was not the market of 2021. The Federal Reserve's benchmark rate had moved from near zero to above 5%. The revenue multiples available for high-growth consumer platforms had compressed by 50 to 70% from their 2021 highs. The narrative around grocery delivery had shifted from permanent consumer behavior change to normalization and margin pressure. DoorDash had spent 2 years as a public company navigating those headwinds and had demonstrated that the delivery category could survive the correction, but not at the valuations the pandemic moment had implied. Instacart's post-IPO trajectory continued the correction. The stock, which had opened at $42 on September 19, 2023, did not sustain those levels. The market closed the session with Instacart at approximately $33, above the IPO price, but well below the opening pop. In the months that followed, the stock moved within a range that consistently placed the company's market capitalization below what the $39 billion benchmark had suggested was achievable. By early 2026, the company had a new CEO. Chris Rogers, who had joined Instacart as chief financial officer and later as president, had taken the chief executive role, marking a second post-founder leadership transition in the company's public chapter. Fidji Simo, who had been brought in specifically to shepherd the company through its IPO, had completed that mandate and moved on. Rogers was scheduled to speak at the Morgan Stanley Technology, Media and Telecom Conference in March 2026, representing a company that had become, in the language of its investor relations communications, a grocery technology platform serving more than 2,200 retail banners across nearly 100,000 store locations, with an advertising and enterprise technology business that had become the primary argument for its public market valuation. The company that Chris Rogers was representing in 2026 bore the structural marks of everything the delay had produced. It was smaller than its investors had priced in 2021. It was led by its third CEO in 5 years. Its equity compensation story was complicated by the distance between the strike prices that employees had been granted and the market prices that had followed. Its public market positioning required it to be understood as an advertising and grocery technology company rather than a delivery platform, a reframing that the business had executed but that the market was still processing. The advertising pivot was real. The technology platform narrative was real. The profitability on an adjusted basis was real. What was also real and permanently embedded in the SEC filings, the funding agreements, and the equity grant records of the employees who had worked through the pandemic peak was the distance between $39 billion and $9.9 billion. That distance is not a rounding error. It is the documented cost of waiting for a moment that did not return. The records from the March 2021 funding round, the internal valuation adjustments that followed, the S-1 filed in August 2023, and the first-day trading data from September 19th of that year together form a complete account of what a 2.5-year delay cost, measured in the only units that private market valuations ultimately resolve into, the terms available when the window finally opens, whatever those terms happen to be. The window that opened in September 2023 was not the window of March 2021. It was the only one left.